Hey everybody, welcome. My name is Matthew. Thank you very much for joining. We're going to take a look at the Repurchase Agreement Market today. This is a continuation of the last couple videos that I did, a refresher on the M1 and M3 money supplies for the United States. I'll remind you again, the Federal Reserve, the monetary authority of the United States, has not published the M3 money supply since February of 2006. And a component of the M3 money supply, remember M3 simply means the most broad money supply. It means the most liquid, non-retail type money, so institutional type money. A component of that is repos, or the Repurchase Agreement Market. Very simply, what is a repo? A repo is a security, typically a treasury security, that trades like cash. Okay, that's what it is. Don't need to go more into that in this video. It's actually a complicated market, but the net of it is that you're trading securities like cash, and you are using leverage to do so. You are leveraging those securities to make trades. So what I have here is the component of M3 that are repos. It's in red line, the red tomato line here. All right, you see that it zoomed up in the 80s, right around the Wall Street crash of the 80s, fell back down in the 90s, and then zoomed up here right when the Federal Reserve decided to stop publishing. It's kind of weird. They said that M3 didn't convey any additional information about the economy that was not already portrayed in M2, but what I'm going to show you, I'm going to reconstruct the repurchase agreement money supply in the United States. I'm going to show you that there's a bit curious language from the Federal Reserve. Okay. So firstly, we're going to put in what's called commercial bank repos. All right. This is basically, remember, anything that has to do with money, or is talked about in a money supply context, that means it's a liability from the institution you're talking about. Okay. So if it's a bank, very simple example, if it's a bank, and you want to talk about money that I have in the bank, that means I have an asset, a claim on the bank. The bank has a liability toward me. It's the same with the repos, okay? So the repo market here that you're seeing this red line up to 2006 is primarily the repurchase agreement market that's done with banks, with commercial regulated banks in the United States, okay? Now, later, after the financial crisis, the Federal Reserve was forced to do some more thorough analysis of the repo market, and they did. But basically, it's commercial bank repos. This is now, I'm going to start to reconstruct my repurchase segment of the M3 money supply. They did that, and that's here, okay? It matches commercial banks, okay? But notice how I have a straight line here. I'll come back to this. Basically, there was a gap from about 2006 to 2012 where they did not, unbelievably, show any commercial bank repo data. But they did show other repo data, okay, from different, whether it be money market funds on the asset side or hedge funds, broker-dealers on the liability side, foreign banks, different banks that were repurchasing, using repurchase agreements in the United States, which again just simply means you're levering up a security and trading it like cash to do things. There were other things that showed up, okay? So that is what's going to be called Shadowbank Repos. And there's a report for this. I'll link to it in the show notes. But I'm going to now put the Shadowbank Repos, which the Federal Reserve now displays on its website, but as far as I know, did not at the time they discontinued the M3 money supply. This is now, I'm going to show you the Shadowbank repurchase agreement amount. Let's take it off. All right. Somewhere around a $500 billion repo market, according to the Federal Reserve. All right. But if you looked at their later reports, post 2008 GFC, you get this number. Stack them together, you're at about $4 trillion repo market as of the GFC year of 2008. 500 billion commercial bank repos, 3.6 trillion shadow bank repos. Now, There's another component, which I'm going to hold off, but I'm just going to zoom out now. And hopefully you can just see how unhelpful it was for the Federal Reserve to weirdly publish some backwards compatible data of the repo market, but stop publishing M3 in February of 2006. It's not helpful. And in my opinion, they lost control of it. And I'm not the only person that has that opinion. Let's reset the zoom and let's look all the way out until today. Okay. Notice here, I'm going to zoom in. Notice here from 2006 to 2012, the dark green shaded area, the commercial bank repos. I had to literally do a linear extrapolation, a regression between when they started publishing data again crazily in 2012, the nation's monetary authority, versus when they were tracking repos in pre-2006, which were also clearly commercial regulated bank repos. They don't specifically say that, but I assume that they were, because the Shadowbank repos, all right, the hedge funds, the money market funds, they were clearly outside of that if you just look at the numbers. All right, so the GFC, you see a big fall here, huge fall in the overall amount, and then you see it raise back up really quickly up to 2012, and then an interesting fall here in the Shadowbank repos. Big rise up here, and then a fall here during COVID, and then a further rise here. So this looks kind of weird. Is this the entire repo market? Well, the answer is no, because post GFC, the Federal Reserve also provided liquidity to non-banks in a sort of monetary base-like fashion, except they were doing it not to banks, which they also did post global financial crisis, but to non-banks, to money market funds, hedge funds, broker-dealers, foreign banks, whatever it might be. And that amount is called the Federal Reserve Reverse Repurchase Facility. It's confusing again. When they say reverse repurchase facility, that's from the perspective of the counterparty of the Fed. Okay, so reverse repurchase agreement is an asset. Repurchase agreements are always liabilities. That's why I just call them repos, part of the money supply. What did I say? Taking a moment to remind you that this show is brought to you by Trezor, home of the original Bitcoin hardware wallet. For over 10 years now, Trezor means business in Bitcoin security and functionality. When using their wallet software Trezor Suite to connect to the Bitcoin network, you're automatically connected via Tor, protecting your identity and giving you full control of your coins in a fully open source manner, both on the software level and on the hardware level. So head on over to Trezor.io to grab your Trezor Safe 3 with a secure element, Model T with a touchscreen, or the original Trezor 1, as well as a ton of available accessories to back up your keys and keep your coins safe. This show is proud to be associated with Trezor. Repos are part of the money supply as they are counted up from the liability section of the counterparty, okay? So there's another huge counterparty that entered the market, the repo market, post-GFC. Who is that? Well, it's Federal Reserve. And I'm going to show their portion of the repurchase agreement market now. All right. So what you have here now stacked up is roughly, as I estimated, the repurchase agreement market in the United States. Okay. You have the Federal Reserve has a huge portion of liabilities, which has fallen a lot in the last year. Let's just zoom in. Now it's only about 1.1 trillion, but at the peak of COVID, or a little bit after the peak of COVID, it was at $2.6 trillion. Tack on another interestingly similar number to all the way back from 2006. Commercial banks haven't really moved in their view of repurchase agreements or their usage of repurchase agreements. Commercial banks tack on another 500, 600, 700 billion. And then you got the shadow banks, $4.5 trillion of repos. Now this even just assumes that, the Federal Reserve is counting these up correctly. Maybe they are, maybe they aren't. Remember, I usually say treasury securities are what are repoed, and typically that is the case. But pre-GFC and remember pre-GFC, global financial crisis, there was this huge light green area that the Federal Reserve was not reporting, and that was not bank repos. Okay, so what was that? There's foreign banks, and there were other assets that were being repurchased. For example, badly packaged and managed mortgage-backed securities. Those were being repoed as well. Those are surely counted in here as well. I don't have a breakdown, treasuries versus mortgage-backed securities. Surely it was both. Surely there was bad risk upon bad risk that was layered on top of the markets here. And this is an entirely different picture if you look at it this way than, say, our M1 money supply of demand deposits, which were, if you listen to some schools of thought, they will say that that's the end all and be all of banking is the sacred demand deposit. They weren't out of control at all. Pre-GFC and even post-GFC. They did get a huge stimulus boost during COVID, which is not good. I'm not defending it. But this is part of the story of the crash. You see a massive boom here to where you get over $4 trillion worth of repos. Massive bust. And then this sort of growth again, but unbelievably the growth of the Federal Reserve providing liquidity to market actors here where it peaked to where the repo market peaked here. Let's just add it up. 2.6 plus 700, let's call it 3.3 trillion plus another 4.1 trillion, 7.5 trillion dollars, according to the Federal Reserve's numbers of repos. 7.5 trillion dollars as of a year ago, and that's down to right now about $7 trillion. That's the repo market. All right. So I haven't even scratched the surface. All right. I've talked about repos before. I've shown this chart before, probably about a year ago now on this channel. We'll keep tracking this, but if you ask me, it's M3. All right. It's the broader money supplies that are wreaking havoc on the economy. It's not the narrow money supplies, M1. And you can just see that by looking at this beautiful tomato line that the Federal Reserve used to publish up until February 2006. It was only commercial bank repos. Didn't track Shadowbank repos at all. Layer on their own repos, and you got a huge bag of liquidity that is sloshing around and trying to manage risk, layering risk upon risk of treasury securities, mortgage-backed securities. All of this is part of the markets, and this is just the United States. Hope this helped you. Let me know what you think in the comments. Thanks for watching.